So what we are going to do today, we will talk a little bit about, treaty interpretation, some of the common themes of interpretation to treaty. Then we'll come to the protocol to the tax treaty. What is a protocol? Your MFN is something that features in a protocol normally, not necessarily. So we'll talk about protocol, the MFN clause. What are the issues with the MFN clause? So we'll come to that. Then we'll come specifically to some of the Indian rulings and some of the foreign decrees, foreign statements on the MFN clause. Finally, we'll talk about, the CBDT circular. I think Sachin spoke about both concentric decision and the CBDT circular. So we'll cover both of these, towards the end of the session. And then, we will kind of talk of, what are the key takeaways. So we'll touch upon, what are the impact areas for all of us as well. So, I'll dive into the topic, and, the first topic is, of course, treaty interpretation and some of the basics. There's something that all of us know, but always, good refresher. The Vienna Convention on Law of Treaties. There's something that was signed in 1969, and somewhere a lot of countries have signed up to this. About 116 countries have ratified this Vienna Convention. US has signed this but not ratified. India has not even signed it. But this is something that is popularly followed across the world, including in India. And this convention, of course, says that an international agreement concluded, between states in written form and governed by international law, whether embodied in a single instrument and whatever its particular designation. So it covers all kinds of treaties, all kinds of agreements. And, we are talking of treaties which are signed by two countries to regulate matters pertaining to tax. SSEs are not party to a tax treaty. It is the two governments, two countries who are, signatories to a tax treaty. It impacts SSEs, it impacts taxpayers. They are not a party to the treaty. And of course, the desire is to make, the business environment friendly. And, this is where, I think Klaus Vogel in his commentary has somewhere said, a tax treaty neither generates a tax claim that does not otherwise exist under domestic law, nor expands the scope or alters the type of an existing claim. This is the popular understanding of what a tax treaty should do. It should be for two countries to agree to share tax revenues equitably. It should be to mitigate hardships. We have seen instances where this is not always followed. We've seen instances where treaties end up creating tax claims. So, it need not necessarily always be true. Coming to, how India has looked at this Vienna Convention, it is not a signatory to this treaty. But having said that, whether you look at the Azadi Bachao Supreme Court decision or the Ram Jethmalani Supreme Court decision, these have relied on the Vienna Convention. And they have said that it provides a broad guideline as to what could be an appropriate manner of interpreting a treaty. And that is where, there are various articles in the Vienna Convention, and, two articles that, we've highlighted here. One is Article 26, which has this concept of, pacta sunt servanda, which means every treaty must be performed in good faith. You go on to Article 31, again, it says every treaty should be interpreted in good faith with the ordinary meaning to terms in their context and in light of treaty's object and purpose. So this is the basic theory, I would say, which is very critical, that, every treaty needs to be interpreted in good faith. And, we will, as we go along, we will look at this concept, a little deeper. But, when we look at how to interpret, India has come out with its interpretation. Some foreign countries have issued their decrees on their interpretation. So how do you interpret? And, somewhere at least the Vienna Convention is very clear. Good faith is important. And they have gone on to say the context for interpretation shall include the text, the preamble, the annexures, the agreement related to treaty conclusion, and the instrument which was made by one or more parties. So it's all the documents which, were there as a part of the treaty, they play a very critical role in interpretation. That's what, in essence, this is. Interestingly, Article 51 of the Indian Constitution, which is a directive principle, that goes on to state that states should foster respect for international law and treaty obligations in its dealings. So in a way, even Indian Constitution recognizes the importance of treaties and says that, we should have respect for international law. So this is the background of, why treaty interpretation is important. And we'll now dive into, the topic of, okay, before we dive into the topic of protocol and MFN, again, how to interpret a treaty, this is one of the famous commentaries, and this commentaries have been quoted in various decisions on treaty issues, even in the Indian jurisprudence. And this is one, the Francis Benion's statement. He says that the interpretation of a treaty imported into municipal law by indirect enactment is unconstrained by technical rules of English law, legal precedent, but should be conducted on broad principles of general acceptation. The words are to be given their general meaning, general to lawyer and layman alike, the meaning of the diplomat rather than the lawyer. So what in essence he's trying to say over here, and this is very important, when it comes to interpretation, he's going on to say that don't try and get into a very hyper technical interpretation of words in a treaty. The treaty is drafted by diplomats, and you should try and give it a layman meaning. You should try to give it a general meaning, and you should not try and get into a very hyper technical interpretation of words in a treaty. It's basically two countries who have bargained collectively and who have come to a common understanding and kind of a negotiated settlement, and therefore don't get into trying to get into every word and try to interpret every word. Try to look at the intention and give it a general meaning. I think that is one important principle which governs interpretation, and this has been accepted in Indian jurisprudence as well. I'll go ahead now to protocol, and what is a protocol to a tax treaty? Now, this protocol is, and IBFD has defined protocol as follows. It's a signed document containing the points on which agreement has been reached by the negotiating parties preliminary to a final treaty. A protocol is also an agreement reached by the parties to a tax treaty and signed and ratified by them in addition to an existing tax treaty. The protocol may be signed simultaneously with the tax treaty or later, and it clarifies, implements, or modifies treaty provisions. So this, if you see India's treaties, in most of the cases, wherever we see a protocol, it's kind of an addendum to the treaty. It's a part of the treaty itself, like an annexure at the end. If you look at the Income Tax Act, you have schedules to the Income Tax Act, and they're very much a part of the Income Tax Act. Protocol is something similar. After you finish the treaty, the last article of the treaty, many a times there's a protocol attached at the end of the treaty, and that protocol, it gives some points that the two countries have agreed on certain articles of the treaty. So it's very much a part of the treaty. And, insofar as India is concerned, Indian judiciary has largely settled this issue that, it goes on to say that protocol is a very important and binding part of a tax treaty. And most of the decisions say that it's an integral part of the treaty with the same binding force as the main clauses. And there are a bunch of decisions over here. There is Teria, which is Delhi High Court. There is Concentrix, which is again Delhi High Court, ITC Kolkata Tribunal, and Sandvik, which is Pune Tribunal. So bunch of decisions, all of which have consistently held protocol is an integral part of the treaty, and it has the same binding force as the main treaty provisions. So that, how important is the treaty, can be understood, from these judicial precedents. And if you go on to, some of the commentaries, and these commentaries, the Claus-Vogel commentaries popularly quoted in a lot of these decisions, he says, as previously mentioned, protocols and in some cases, other completing documents are frequently attached to treaties. Such documents elaborate and complete the text of a treaty, sometimes even altering the text. Legally, they are a part of the treaty, and their binding force is equal to that of the principal treaty text. And when applying a tax treaty, therefore, it is necessary to carefully examine these additional documents. So he is very clear. It has a binding force as much as the principal treaty itself, and that's the principle that a lot of our Indian decisions have also followed. This commentary from Mr. Palkiwala also says protocols are exchanges between states pursuant to finalization of treaty, and they have an equal binding force, and they need not be notified separately. So this is the Indian judicial precedents on the protocol. And now we go on to the next section, which is the MFN clause, which is a part of a protocol. So we have treaty, we have protocol, which is part of the treaty itself attached to the treaty, and MFN clause, which is ordinarily found as a clause in the protocol. So that's the third layer that we are coming down to now. And we'll now see what is this MFN clause. It stands for Most Favored Nation Clause. And what it does is when two countries are signing a treaty, it is in essence telling the two countries are saying that if India were to give a more favorable treatment to some other country, then that same favorable country will apply to the agreement between these two countries as well. So, when negotiation is happening, when between two countries, let's say India and Netherlands are negotiating a particular treaty, and they are finally signed on various terms, India and Netherlands are somewhere saying, if you go and sign a treaty at a later point in time, which is giving more benefits to some other country, then we would want those benefits, to apply to us as well. It is not necessary that all of India's treaties have this kind of clause. There are about 13 treaties, that India has, which has this MFN clause. So, these are the treaties which are mentioned over here. The OECD member states, you have Belgium, France, Netherlands, Spain, Sweden, Switzerland. I think some names not mentioned here. Finland, Hungary, UK. Again, these countries have. So in Europe, it's quite popular to have this MFN clause. Among the non-OECD states, you have the Saudi Arabian Treaty and the Philippines, which have an MFN clause. So this is, the MFN clause, and I will show you, a sample of, some of these MFN clauses as we go along. And the idea is that, like I said, if India gives a favorable treatment in terms of rate of tax, in terms of what is the scope, the same treatment, should apply to the first treaty as well. And it is to promote non-discrimination. It's to promote parity in business and investment opportunities. And, it's really because treaties are, it's a collective bargaining document at the end of the day. So the two countries somewhere want to ensure that, they don't lose out because they have not bargained enough. They want to ensure parity with everybody else. And therefore, they have put in these kind of clauses. Now, recently, if you look at it, while treaties, the MFN provision was designed with some intent. If you look at the whole controversy on dividends, the Indian authorities will say that these MFN provisions are now proving to be disadvantageous for countries, like India, which, are the source jurisdictions. So this is really the background of, the MFN clause. And, some critical points over here, it need not necessarily be reciprocal. So if you look at the India-France DTAA, it says if India were to sign a different treaty with a lower rate or a lower scope, then the same rate or scope will apply to India-France treaty also. So it is talking of only India doing something. It does not cover France. And, if you were to reflect as to why it didn't have, why was it not reciprocal? The answer could be that when that treaty was signed, at that time, France, was not taxing some of these income streams. And, therefore, it was only India which was taxing, and therefore they covered India. Now, if at a later point in time, France were to tax it, it gives a very peculiar situation that the MFN is not extending to the France side, which is peculiar. So, it depends on how the agreements are worded, how the MFN clause in the protocol is worded. We need to look at it carefully. Again, the popular streams where MFN really is applied, we've seen royalty, fees for technical services, and dividends. These are the more popular streams. But, there are others also. Business profits is one such example. So the treaty with UK, treaty with Saudi, these are cases where the MFN benefit is extended to business profits also. The UK treaty goes on to say that, if there is a restriction on general and administration expenses, insofar as calculation of business profits is concerned, the percentage of general and administrative expenses that are allowed, if that is more favorable with some other country, the quantum of deduction, the same terms will apply to the India-UK treaty as well. So, those kind, it depends. Each treaty has different language and it applies to different provisions. Again, it can either be automatic or non-automatic, in the sense that some treaties say that the two governments will talk to each other and come out with a notification. Some treaties have a language where, the view is that it should be automatic. And that's one view where there's a big controversy with the government. The tax authorities, government view is it is never automatic. It always is non-automatic is the government view. But, we have a point of view to say that, one has to look at the specific language of the MFN. And in some cases, it can be automatic. And in some cases, it can be non-automatic. Again, from a date perspective, normally treaties have a language to say if India signs, let's say India signed treaty with a country in a particular year, and if India signs a treaty with another country after that, then the subsequent date becomes relevant cutoff date. And it says that, any new agreement, any new treaty that India signs after that date, that same beneficial provision will apply to the first treaty also from the date that India signs the new treaty. That's how normally it is worded. There are some treaties which don't have a date, which says, let's say you're sitting today in 2022. And let's say that, normally you would have worded to say that if India signs any treaty after this, then that provision will apply to a treaty today also. But there are some treaties which, don't have that language. They have language to say if India has signed a treaty on any date, then that beneficial provision can be imported into the treaty being signed today also. And one such example is the India-Sweden treaty. The MFN clause in the India-Sweden treaty does not have a cutoff date. It can go back as well, which is not normal, and which is not tested yet with the Indian authorities. So we need to see the Indian authorities' view. But we have seen that we have a view to say you could look at importing the India-Greece treaty provisions into the India-Sweden treaty. Under the India-Greece treaty, fees for technical services not taxable, and one can try and take that view in the India-Sweden treaty as well. So the date becomes very relevant. There is one judicial precedent. I think there's a South African advance ruling which has looked at this, and it was in the context of the South Africa-Sweden treaty on taxation of dividends. It went and looked at, the South Africa-Sweden treaty was signed in 2012. It went and looked at the South Africa-Kuwait treaty, which was signed in 2004, and gave the benefit of the lower rate or the nil rate of tax in the South Africa-Kuwait treaty to the South Africa-Sweden as well. So, this is tested overseas. In India, we are yet to come a precedent on this retrospective application. Some popular, simple instances here, which we've just put up over here. One is, of course, this is a Spanish entity, let's say ESCO, which is rendering technical services to the Indian entity. The India-Spain treaty has a rate of 20%. And, what we look at doing, and, of course, the India domestic law has a rate today of 10% and 10% plus surcharge and says, let's say it's 11%. Question is, while the Spain treaty has this 20% rate, what we would, how we would do it is to see is there a MFN clause in the India-Spain treaty? Yes. Does the India-Spain treaty then, then you look at, are there other treaties which can give us a better rate than the 20% rate? And which is where sometimes you may get an answer that, there are other treaties that India has signed, which has a rate lower than 20, which is 10%. So you will import the 10% rate into the India-Spain treaty. So when you do a tax deduction in India, you can import this rate. Sometimes instead of a lower rate, the answer could even be a nil rate. So it depends on treaty to treaty and situation to situation. Some examples that we've given over here at the bottom. So, Netherlands treaty, it has a very broad definition of fees for technical services. If you look at the MFN clause of the India-Dutch treaty, you can rely on the US treaty, which has a narrow definition of fees for included services. It has a make available concept, and you can import that into the Netherlands treaty using the MFN clause. In the India-Hungary treaty, interest on government securities is taxable. Again, India-Hungary treaty has a MFN clause. You can rely on the, another treaty, either the India-Portugal treaty or the India-Italian treaty, which give an exemption to interest on government securities. So, there are, again, Belgium treaty, the royalty definition covers equipment royalty, but it has a MFN clause, and the India-Sweden treaty, the equipment excluded. So you can you can introduce the exemption which is there in the Sweden treaty to Belgium, and cover Belgium payments, and say that they also will enjoy this exemption. So the MFN clause is normally used to benefit, to bring down the tax rate. So it is of interest, I would say, to everybody, especially Indian companies who are doing intercompany group payments, where this tax can end up being a cost. This is of particular interest to ensure that tax are kept below. I think chartered accountants issuing certificates, the 15 CB certificates also, this is important, to ensure that, the MFN clause has been appropriately considered, when looking at TDS to be done on intercompany payments. So with that, I'll go down to, the next slide, which is really an example of, some of the MFN clauses. We've extracted some of these clauses over here on the slide. This is the first one, is the India-Sweden MFN clause. And it says that in respect of articles on dividend, interest, royalty, and FTS, if under any convention or protocol between India and a third state, which is a member of the OECD, India limits its taxation at source on dividends, interest, royalties, or FTS to a rate lower or a scope more restricted than the rate or provided for in this convention, the same rate or scope as provided for in that convention, agreement, or protocol on the said items of income shall also apply under this convention. So this is Sweden. Similarly, if you look at France, it again says, it talks of India should limit its taxation at source on dividends, interest, royalties, FTS, and payment for use of equipment to a rate lower or a scope more restricted than the rate or scope provided for. So, again, it has a language to Swedish treaty, and, the MFN is similarly worded. Now, this is interesting. The next one, which is Switzerland, it says, if India limits its taxation at source on dividend, interest, or royalties, or FTS to a rate lower or a scope more restricted, then, so up to this part, it's all similar. It says Switzerland and India shall enter into negotiations without undue delay in order to provide the same treatment to Switzerland as that provided to the third state. And, this is a little dated provision. We have a new provision to this, and I'll come to that shortly. But the important point here to note is it talks of India and Sweden shall enter into negotiation. So it does not say it automatically comes into effect. It talks of a negotiation happening. Whereas these first two treaties, it just says that if there is a lower rate that India signs, then the lower rate will apply. You go to Philippines, which again says if India, signs a lower rate or a nil rate, then the two governments will undertake to review these articles with a view to providing such lower or nil rate to profits of the same kind. So, each MFN clause is differently worded. This Philippines one does not talk of scope. It talks of only a lower or nil rate. Whereas if you see Sweden, France, Switzerland, they talk of rate and scope, both of these points. So every MFN is differently worded. And when interpreting these provisions, needs to look at what is the exact language in each of these MFNs to decide. If you see over here, the word agreement or protocol, that is used at the start. And this word protocol, while it is there in each of these that you see over here, Sweden, France, Switzerland, it is missing in some of the MFNs. So for example, in Netherlands, Finland, Belgium. So, what is the impact of that? One has to look at the specific language to see how to interpret, this MFN clause. I'll take a pause here. Any questions so far? And then I'll come to some popular issues, that, we've come across, specifically on the MFN clause.
Pramod, I have one question.
Yes, Sachin.
I think you have very specifically put erstwhile provision as far as Switzerland. So I think you are going to discuss something more. But I think what I recollect was Switzerland, as far as the scope was concerned, it was automatic, and as far as the rate was concerned, it was some negotiations needs to be entered. This was maybe my understanding. You can clarify because as you rightly said, Sweden and France, it was a straight away, automatic application of MFN was there. So that's my one question. And second, just on a concept level, when we say some protocols requires renegotiations, either for scope or for, rate, uh, concept, this an MFN clause then? It just, suggests that the two treaty partners will sit together and, start negotiating that terms. So renegotiation kind of a thing. So where is this MFN concept fits in, uh, you know, the whole objective of, MFN which we are, discussing about? So these are the two questions which I have.
No, thanks, Sachin. So I think very valid questions, and see, first and foremost, what you have raised doubt, that if the MFN just says that the two countries will negotiate and agree, then is it really even an MFN? The only point there is that there are a lot of treaties which don't even have that. So, the question is that, at least there are some treaties where there is an obligation on the two countries to sit together. It shows an intention of the two countries when they signed the treaty and the MFN and the protocol to say that they'll sit together and agree to some changes. So to that extent, I still say that it is an MFN. It's not an automatic application. So automatically, the rates or the scope will not go down. But the point is valid that that there is a difference, where in terms of countries where it is automatic versus countries where it is non-automatic. And insofar as the Indian revenue side is concerned, it's non-automatic in all cases. So we'll come to that controversy shortly. I'm just trying to share. Okay, is this visible now? Just give me a minute. I'm just sharing the protocol to the India-Switzerland Treaty. Is this visible on the screen?
Yes, visible.
So if you see this, protocol, and this is, this was something that got amended over here, and it says over here, and if you read it over, it says, the provisions of Article 10, 11, 12, and 22 shall not apply to any dividend, interest, royalty, or FTS paid as a part of conduit. So this conduit part we can keep out. Then you go to this paragraph over here. It says, in respect of Articles 10, 11, and 12, if under any convention, agreement, or protocol between third state which is a member, India limits its taxation at source to a rate. So it talks of rate over here. It says if a rate is lower than the same rate shall also apply between both contracting states under this agreement. So it says this part is saying it automatically applies. Then after that you go to the second part. It says if after the date of this amending protocol, India under any of this restricts the scope. So here it talks of scope, and it says if India restricts the scope in respect of royalty or FTS, then the scope for these items provided in Article 12, then India and Switzerland shall enter into negotiations without undue delay in order to provide the same treatment to as that provided in the third state. So this is a very peculiar situation. Dividend is not covered in the second part. It talks of only FTS and royalties, and the rate part is automatically covered over here. So at least my personal view, and let me just repeat, whatever views I am sharing are my views, not the views of the firm. My view is, they're very clear that insofar as rate is concerned, it should automatically apply for dividends, for interest, for royalties. You don't need any further negotiation, any further notification. Whereas if you're going to rely for the Sweden treaty, you want to get a lower scope. Let's say you want to refer to some other treaty which has a make clause and you want to incorporate that, then that can happen only if negotiations happen, and after negotiation there will need to be a notification. So that's the way I would interpret this.
Perfect. Thanks, Pramod.
Thanks. I will just go back to the presentation. I don't know if the presentation is visible. I have tried to.
Yes, it's visible.
Okay, great. Any other questions? So I'll proceed then. And one of the popular issues has been on taxation of dividends. And you are aware that in India, 20, we've changed the entire law of dividend, taxation of dividends. We had DDT earlier, and from April 20 onwards, now dividend is taxed in the hands of the shareholders. DDT is no longer applicable. Now, insofar as dividends is concerned, India has these interesting treaties. One is a treaty with Slovenia, and that Slovenia treaty says dividends, and this is the Article 10 of the India-Slovenia treaty. It says dividends may be taxed in the state of which the company paying dividends is a resident, but it shall not exceed 5% if the beneficial owner is a company which holds at least 10% of capital of the company paying the dividends and 15% of the gross amount of dividends in all other cases. So this is dividends in the India-Slovenia treaty, and similarly in Lithuania also, the Article 10 talks of a 5% rate if there's a 10% beneficial holding. So significantly lower rates. And the question then that comes is, can I rely on these treaties to say that this lower rate of 5% is applicable even to my treaty? And when I say my treaty, I'm talking of in treaties which have a MFN clause. If they have a reference to dividends and a rate lower, can Slovenia and Lithuania be invoked is the question. And this is where, it's interesting to note the sequence of events that have led, that have happened insofar as MFN clause is concerned. And, we've tried to capture, the sequence over here. The dates of various treaties are mentioned here. So Netherlands, France, Sweden in that order, and these are the dates. And then Slovenia became a tax treaty member on 17 Feb 2005. Now, when India signed this treaty with Slovenia, it was not a OECD member. It became an OECD member on 21st July 2010. In 2012, the Dutch authorities issued a decree saying that the tax rate in the India-Netherlands treaty on dividends shall be reduced pursuant to the MFN clause retroactively from the date that Slovenia became an OECD member. So they've said if Slovenia has become OECD member from 2010, India now has a treaty with a OECD member with a rate lower of 5%. So the 5% should apply. Similarly, in July 12, July 14, there are these other treaties, Lithuania, Colombia, that India has signed, with similar 5% rates. And the French authorities issued a decree in November 16, which said again that the tax rate shall be reduced pursuant to the MFN clause retroactively from July 10, since Slovenia became an OECD member. And, finally, the Swiss authorities, about a year back, they published this guidance to a statement saying that the lower rate of 5% shall apply for shareholding about 10% from 5th July 18. 5th July 18, I think, is the date on which, the Lithuania treaty came into effect. And, they said from 28th April 20, this is the date on which Colombia, I believe, signed, the Colombian treaty came into effect. So, these are the various sequential developments that have taken place so far. And, if you go back and see over here, it says in respect of this, if under any convention between India and a third state, which is a member of the OECD. Now, is this a member of the OECD? So the question that is going to come is each of these countries, Slovenia, Lithuania, Colombia, on the day they signed the treaty, they were not an OECD member. And they became an OECD member subsequently. And, therefore, the issue that came up, is that, does the country have to be a member both at the time of conclusion of the treaty as well as at the time of applicability of the MFN clause? Or can I say that, when I'm applying the MFN clause, at that time, is it an OECD member? Is that what I should see? That becomes, issue number one, really. Issue number two, again, there are decrees issued, by different authorities, and we'll come to the decrees shortly. Are those decrees applicable, valid? What do the judicial precedents say? I think so that becomes issue number one insofar as the MFN clause is concerned. And issue number two, is on this, whether a separate notification is needed, or does the MFN clause is itself operative? And you saw, language in the India-Swiss treaty. Excuse me. At least, my view is, it can be self-operative in certain circumstances. But, again, what are the judicial precedents on is it automatic or self-operative? We will talk about that, as we move forward. So first issue, which is the first issue being, when does the state have to be a member? Insofar as that is concerned, the Swiss authority statement on 13th August, they have said, that while the two new treaties that India signed with Lithuania and Colombia, from the date they became OECD members, which is 5th July 18 and 20th April 20, from that date onwards, the lower rate will apply insofar as, all transactions, pertaining to the India-Swiss treaty are concerned. In fact, this statement of the Swiss authorities, it goes on to say, if there are India headquartered companies with subsidiaries in Switzerland who have got dividends from the Swiss subsidiary, they can ask for a refund from the Swiss authorities, up to a 3-year period, and say that this lower rate of 5% should have been applied. And, they can apply to the Swiss authorities for a refund as well. So that's what the Swiss authorities issued this statement. The Dutch guys, their decree is a little older. And, they have also said, Dutch companies, insofar as India, Netherlands payments are concerned, they have said that the Slovenia 5% rate, because, Slovenia became a member of OECD from 21st July 2010. From that date onwards, any Dutch company paying dividend to a company in India, the tax rate is reduced from 15% to 5%. So that again is the Dutch decree. You similarly have, the French authorities who have issued a decree. And, this was the decision which has been quite, controversial, so to say. And, Sachin mentioned this right at the start. This is a Delhi High Court judgment. And, this is in the context of, it was in the case of Concentrix. And here, Concentrix, is a Dutch entity, a Dutch group. And, it was a subsidiary of Concentrix Services Netherlands BV, the Indian entity. The Indian entity went and applied for a 197 certificate to say that, when I pay dividends, instead of the treaty rate, the India-Netherlands treaty has a 10% rate. But, the the Indian company said, I want to apply the MFN clause with respect to the India-Slovenia treaty, bring a 5% rate and only pay tax, deduct withholding tax of only 5% under the India-Netherlands treaty. Now, the authorities ended up saying, sorry, we don't agree with this. There is no notification that India has issued saying that Slovenia treaty benefit can be introduced into the India-Netherlands treaty. Therefore, you continue with 10% rate. That is what, the Indian authorities said. And, which is where, what Concentrix did at that time was, to go to the Delhi High Court by way of a writ. And, this decision that then came out as a favorable decision of the Delhi High Court. And, they have looked at these issues to say that, even if Slovenia is not a member at the time of signing of the treaty, what is really required is to see at the time of application of, this withholding, is Slovenia a member of the OECD or not. And, they have relied on this, the word is, if you go back a little bit here and see the word is over here, which is there over here. The department was trying to use the same terminology to say that, they need to be, the other country should have been a OECD member at the time they concluded the agreement. Whereas, the Delhi High Court interpreted this word is over here in a different fashion. And they have said, they've gone into a lot of nuances of how to interpret the word is. But they have somewhere said that, this really means you should look at the point in time when you're doing the payment. At that point in time when you want to apply the treaty, was Slovenia a member of the OECD? That's how you should go and interpret, is the way, the Delhi High Court gave their interpretation. Again, they said there is no separate notification. They said that the plain reading of the India-Dutch treaty clearly shows that, that protocol is an integral part of the treaty. And, there is no requirement for negotiations, notification. All of that is not coming out from the MFN clause. So no separate notification is required. So these two principles on both the issues, Delhi High Court gave a very clear verdict. And the Delhi High Court has been followed. There were 3 or 4 subsequent Delhi High Court verdicts as well, following this same principle. You go to the second issue on notification now. And
Pramod,
yes,
sorry,
yes.
I have just one point on this important issue.
Yes.
So, there's nothing to be complained about, from the assessor's perspective as far as concentric is concerned, because it gives you a benefit. But, just thinking, on a broad principle, if you really look at from the government perspective, we always, try to look at, where is this powers coming from to enter into DTAA. And then we travel to Article 246 of the Constitution, then 253 of the Constitution. And the Article 253 says, notwithstanding anything contained, so it overrides 246 of the article of the Constitution. So essentially, it gives an overriding, impact at the constitution level itself for these agreements with foreign countries. Having said Section 90, subsection 2, all said and done, yes, whatever is beneficial, you do it. But don't you think we are going overboard here, in a sense that if I am giving an MFN clause let's say I am negotiating with Netherlands and I am giving them this MFN clause, it is given because of the transactions with that country, and whatever has considered thoughtfully at that point of time, you have given them this particular benefit. And at that point of time, you are already aware that possibly looking at the trade, the volume, the future economic benefit, this is the right country for which I should give this MFN. But when we are really talking about this Slovenia, when I'm entering into the Slovenia treaty, I don't know, frankly, the trade transaction with Slovenia, it may be in just 1,000 USDs or, some millions of USDs. These are so small countries, possibly only for those small countries we have, given that benefit. And at that point of time, when Indian government has negotiated those treaties, they were not part of OECD. And that is why possibly they have given only considering those treaties status at that point of time, and the small trade possibly some rate reduction or the scope reduction as far as any particular article is concerned. So considering this background, don't you think that the Indian government is possibly right in contending that whenever you are taking the benefit of these MFN clauses and taking your recourse to Slovenia, Lithuania, these are the countries. But when we entered into DTAAs with those countries, they were not the OECD countries, and that is why we gave them the benefit. And therefore, now you should not import this benefit to Netherlands, France, and the bigger countries with which we have a trade. So don't you think, logically speaking, the views of the Indian government seems to be right, or you still follow concentrics just because it is SSC friendly? What's your view on a very broad view, Varada?
So I think, Sachin, you articulated the other view very, very well, I should say. And the government, it is not, there is a fair argument to to what you have just articulated, which is really the government's point of view as well. Somewhere to say that that when we signed a Slovenia or a Lithuania or a Colombia treaty, we had whatever negotiations that we had with those countries, and maybe we calculated an impact. Which said that even if we give this 5% rate, it's not going to be a big loss to the Indian coffers. We want investments from these countries to come into India, so we'll give them a lower rate. Maybe that was their calculation, and those countries subsequently becoming OECD members, and then some of these larger countries, maybe that was never intended, and I would agree that the government didn't anticipate that to happen. But the fact still remains that insofar as Netherlands is concerned, insofar as France, Sweden, these other countries are concerned, the government ended up giving them an MFN clause. The government, very well, was aware that if they were to sign a treaty with a OECD country with a lower rate, then the lower rate is going to be imported into these MFNs. So that they were aware of. Now, the fact is, a subsequent development of some of these countries, becoming OECD members, is that something that, they were aware of? They were not aware of, how would that impact the MFN clause? They didn't factor that this will happen. But, the point is, again, insofar as Netherlands or investors from Netherlands are concerned, they are going to say, if India gives this benefit to anybody else, we also should get the benefit. The good faith that we spoke about, at the time, we spoke about the Vienna Convention of, interpretation of treaties, Article 31, which said that treaties should be interpreted in good faith, and which is where, how do you, the at least the Netherlands side, they put up decrees, and we saw the sequence over here that in 2012 itself, the Netherlands side issued a decree which said that that Slovenia, since Slovenia became a member, the lower rate will apply. Now, after that date, India, signed up this Lithuania Treaty, Colombia Treaty. It's only recently in 2022 that India has issued a circular giving its point of view to say that, you shall not interpret it in this fashion. See, the decree has been there for quite some time. And, India's point of view that, this lower rate should not extend has come in only recently. So, in that sense, there has been a long period of uncertainty. If you personally ask me, what my view is, I would still, go with the concentrics view, and, see, at the end of the day, the idea is to promote investments. The idea is, the two countries, when they negotiated, they said, we'll give a more beneficial position to Dutch investors compared to a lot of other investors by putting in an MFN clause. So, there was some intention to give a benefit. Now, how that benefit should be given, the two countries are having a different point of view. Netherlands has one point of view, India has a different point of view. And, ultimately, both the countries should arrive at a conclusion to have the same point of view. And, which is where, I would always tend to take a view that, the view beneficial to the SSE should be followed. And, here it's even supported by judicial precedent. So to that extent, there is a benefit as well. So I don't know if I have answered your question, Sachin, but, I understand the point you're making and, the view of the revenue authorities, which is again articulated in the circular that I'll come to. But, I still think, the view that, that this benefit should be extended insofar as the dividends are concerned, is a very valid view.
Thanks, Pramod.
Interestingly, one more point I would like to just add over here. Okay, maybe I'll come to that later, but, this decision and this issue of whether, you can still continue to apply this concentric decision post the CBDT circular, that is again subject matter of a new writ petition in the Delhi High Court. So I'll come to that towards the end maybe. But, we will have some answers on that, very soon is what I believe. So I'll move ahead to the second issue, which was on the notification. Is a notification needed, for implementing an MFN? And, the CBDT views that a formal notification is needed. But, my point of view is that, notification is not needed. We did see the Swiss treaty, which said that if the scope for royalty and FTS is to be reduced, then India and Sweden will enter into additional negotiation. There's a very specific language. So wherever that language is there, yes, you need to have negotiation, you need to have a notification. But wherever there is no such language, it should be automatic. Again, there are some provisions, the Article 12 of India-US treaty, it says, there is a 20% tax rate on royalty FIS for the first 5 years, followed by a 5% rate. There are provisions in various treaties which talk of a particular rate for a certain period, followed by a different rate, at a later point in time. So all of that, if we take a view that for every change in a treaty, there has to be a notification by the CBDT, it is going to make life very, very difficult. and it is going to make virtually a lot of provisions I would say non-operational. There is one famous ruling on this topic on notification, is it automatic or not, and which is again a Delhi High Court ruling. And the fact pattern here was a French entity called Steria. It provided managerial services to the Indian entity, and at that point in time, the the India-France treaty provided for a 20% tax rate on such payments. And the question was, can a lower rate be taken by Steria India, applying the MFN clause. And it went to first, the company filed an advance ruling. The advance ruling was in favor of the revenue, where they said that the restriction is in relation to rates. So they somewhere said that the India France DTAA, it talks of rate of taxes, and the make available term is more a scope related point that cannot be invoked, and that cannot be part of that cannot be read into the protocol. That was one point they mentioned. And they also said that there was a formal notification which India issued insofar as the India-French treaty is concerned, where India and the Indian government in the notification recognized some subsequent treaty developments and said that insofar as India and France is concerned, these ABCD developments we are recognizing, and we should give benefit on these ABCD developments. So some developments, some more beneficial provisions, they said will apply to the India-France DTAA as well. But make available was one provision they did not refer in the notification. And the AR ruling said the government has issued a notification on the French treaty, recognizing subsequent treaties entered into by India, and also saying what benefits can go into the French treaty. So it's a very clear guidance from the Indian government, and you have to follow that guidance. You cannot not follow that guidance. That's what the AR ruling said. And there was a writ filed against this ruling, went to the Delhi High Court, and Delhi High Court said it disagreed with the advance ruling, completely disagreed, and it said we are sorry, but the lower rate and the scope, you can go to one treaty for a lower rate, and you can go to another treaty for a lower scope. You can't say they are mutually exclusive. It can happen under more than one treaty. So you while interpreting the India-France treaty provisions, you can say that for the lower rate, I am going to the India-Sweden treaty, and for the lower scope, I am going to the India-Finland treaty. They said that's perfectly fine. This mix and match approach, it's a very favorable ruling in that sense, but that's what Delhi High Court held. It then went on to also say that the MFN clause is an integral part of the treaty. There is no need to separately notify the MFN clause. And once the treaty is notified, the MFN clause, will automatically apply. This again, decision, it did take note of some of the earlier decisions, including the ITC decision of the Kolkata Tribunal when arriving at their decision. But it said just because India has issued a notification, that's out of abundant caution that India may have issued. But that does not mean the interpretation will change. India has not recognized the make available principle while issuing that notification. But that does not mean that you cannot import the make available principle. So this, there is a very, very good ruling on the MFN clause and the automatic application without a notification, that has been recognized by Delhi High Court. The Indian government again does not agree with this. They have filed an appeal to the Supreme Court. So this matter will eventually get decided by the Supreme Court. But insofar as things stand today, this High Court and subsequently there are multiple tribunal decisions, including Pune Tribunal, which have followed this principle, which have said that, depending on the language of the MFN, you could have a very automatic application. And, just going back to the other point that Sachin mentioned, there are some treaties, in some of the treaties entered into by Australia actually, which have a very specific language, which say that the lower rate, which is to be applied, one has to evaluate whether when the country which was signing the subsequent agreement, was it a member of the OECD at the time of signing? There is a very different language in those treaties which say that, were they members at the time of signing the agreement with that country, only then will you import. That kind of language is there in some of these specific treaties that Australia has signed. And I would distinguish that language with our Indian language, which merely says, is it a member of the OECD? And then how do you interpret that? So to that extent also, I would say that the Indian government, while it has a point of view, I would more go with this concentric and stereo decisions. So I'll take a pause here, before we go on to the CBDT circular. Any questions?
Pramod, I have a question, but unless someone else wants to first ask me a question, I'll just pause.
Yeah. I'll just give it a few seconds before we dive into this CBDT circular.
Okay. Anyone else would like to ask any question? Okay. So Pramod, I think, we are discussing the benefits, which we are otherwise getting because of this MFN clause through other treaties. Now, when we are taking the benefits, one issue which has now arisen post MLI is, let's say, for example, you would like to avail the India-Slovenia treaty for a dividend article, but that dividend article is now been amended because of the MLI Article 8 provision, which now further adds the condition as to 365 days holding. So my simple question is, whenever you are referring to any other treaty benefit from a country like Slovenia, Lithuania, or any other, where the MLI has now changed its position, either very specifically in that particular article, or it has now added, let's say, a PPT test, or some treaties have also a SLOB test. So whether you take the benefit of that other treaty only with respect to rate or scope, or these conditions attached in that particular treaty, either specific or general, also would get imported while really applying that treaty benefit.
So I think Sachin, great question, and it is introducing another complexity really, where we are saying that when we import a lower rate, let's say a 5% rate, then are we also importing some of the conditions attached to that 5% rate? If MLI has changed and required that you need to have a minimum 365-day period of holding to get the 5% rate, are we importing that 365-day condition also into our treaty? That's the question. And there again, it's a very debated topic. I have seen some authors give a point of view saying, you only take the rate and you don't look at these conditions. My that when you're importing a lower rate, if the lower rate has some conditions attached to it in that treaty, then those conditions also get imported. That's my point of view. And you will probably then look at which treaty has the simplest conditions, or which treaty does not have any conditions. You can do some shopping around that, but per se, if there are conditions, you can't say that I'll only take the plus, and if there are some obligations attached, I will not consider them, I'll ignore them. I think that that is very aggressive, and my personal point of view would be that the conditions will also get tagged.
Excellent. Thanks, Pramod.
So then I'll move ahead to the CBDT circular, which is very recent, about 4 months back. On 3rd Feb 22, CBDT issued this circular on the MFN clause. And what CBDT has tried to do is it has tried to give its point of view on when MFN can be applied, what conditions need to be satisfied when applying MFN. And somewhere this MFN, this circular is focusing on dividends quite a bit, but the principles given in the circular will apply not only to dividend, but any other income stream, whether it be royalties, fees for technical services. Wherever we are applying MFN, this circular will have a role to play. And the circular recognizes that there is this Dutch decree, there is this French statement, the Swiss officials publication. It talks of all of these, and it goes on to say that these statements or decrees issued by these other authorities are grossly incorrect. They have said they didn't consult with us. We have written to them. We have told them that we don't agree with what you are saying. So it has become a very controversial circular. Therefore, if the way the Indian government has articulated is to say that that the third state has to be a member of the OECD at the time of signing. If it is not a member at the time of signing, you cannot import sorry, excuse me, the provisions into our treaty. And it goes on to say that these unilateral instruments issued have no binding effect because they are been issued without any consultation with India. So they're kind of saying, sorry, we don't agree with any of what these foreign countries are saying, or the authorities in these foreign countries are saying. Some highlighted that if you go back to the language of any of these treaties, it says it says that the same rate shall apply. I'll go here, as from the date on which the convention between India and France or the relevant India Convention agreement enters into force, whichever is later, the same rate or scope shall apply. So what they have said is that if you look at this second part, they said that the MFN is saying it should apply from the date the convention entered into force. Now, the date on which, let's say, the Slovenia Convention entered into force, on that date, 17 Feb 05, Slovenia was not an OECD member. Similarly, when Lithuania tax treaty was signed, it was not an OECD member. So if you have to give a very strict interpretation to this language over here, then it becomes impossible to satisfy this, because on that date, these countries were not OECD members. So they have used this to say that, sorry, we don't agree with this point of view. In our view, only if the third state is an OECD member at the date of signing, only then can this benefit be applied. They have then gone on to rely on Azadi Bachao to say that a notification is necessary for amending any provisions of the treaty. And since India has not issued any notification importing these lower rates of Slovenia, Lithuania, this cannot come into effect. I think this, while the first argument is debatable, the second argument of Azadi Bachao is really, to my mind, misplaced, because the Azadi Bachao decision and the relevant paragraph that they've extracted, it talks of a notification for implementing a treaty, which India has very well issued. When India issues a notification for implementing the Netherlands-Dutch treaty or the French treaty, the MFN clause is also a part and parcel of that. And the notification that Azadi Bachao spoke is not of from an MFN perspective, it is of the treaty itself that Azadi Bachao was talking of. At least that that's the way I would read it. Again, they have said that these MFN clauses, you saw the Slovenia treaty, it had this rate of 5% and 15%. If I go back, if you see over here, it says 5% for a company which holds 10% and 15% in other cases. So they said that when you're importing, you can't say you're importing only 5%. That even 15% should be imported into the treaty in cases where the shareholding is not satisfying the 10% ownership condition. So they said you import both parts, and what the foreign governments are saying is they only want to import the 5% scenario, and the 15% they're ignoring. Whereas, and that is precisely why they're saying you can't import anything. So that's again one of the arguments they've put in the circular. It's a fairly detailed circular. And then finally, they've said 4 conditions need to be satisfied for applying an MFN clause. So they said that the treaty should be entered after signature of India's treaty. And they've said that there can be exceptions to this first condition. You could have, depending on the language of the MFN clause, you could have a prior case. As they have not said you could have a prior case, but they've somewhere caveated this first condition to say depending on the language of the MFN. But normally it should be afterwards. Second condition they've said is that the third state has to be an OECD member at the time of signing its treaty with India. So this, for all dividend cases where the 5% is sought to be taken, this second condition is going to be very, very controversial, and it cannot be really satisfied. The third condition is India limits its taxing rights in relation to rate or scope in a treaty with a third state to a lower rate or scope compared to what it was signed, with the first state. So that is the third condition. And then the last condition is India issues a separate notification under the income tax law for importing favorable benefits of the third state treaty into the original treaty. So both this condition number 2 and condition number 4 will be very hotly debated. You will have judicial precedents come up on the validity of this. But the circular is saying only if these 4 conditions are satisfied should an MFN clause be applied. They have gone on to say that the circular shall not be applicable to those taxpayers in whose case there is already a favorable decision by any court on this issue, which even if they had not said, no, I think would have been logical. But this is what the circular says, and what happens insofar as if we were to apply this circular to some of the, and we've spoken about dividends over here. If you look at dividends, there are some advance rulings that were filed prior to April 2020, where the taxpayers went on to say that the DDT rate of 22-23% that should be restricted to the treaty rate of dividend taxation. And whether that argument is valid or not is one matter of debate. But the second issue there was what should be the rate of tax. If that argument that the treaty dividend rate should override the DDT rate, if that argument is right, what should be the treaty rate? Should it be 10%? Should it be 5% relying on MFN? So that controversy is there in these advanced ruling applications, and there are some, I guess, tribunal rulings as well on this. There is a special bench which may come up on that topic. But the rate of tax applying MFN, there is this additional controversy which will now come up, and we'll see how it plays out. But the circular will help the revenue authorities to say you cannot automatically apply the MFN. Similarly, dividends declared after April 20, we've seen some of our clients, who've applied this 5% rate. Some of them have got notices from the income tax office to say, that it should not have been 5% and 10% is the rate of tax in the treaty. So this MFN clause, is not being recognized, and now appeals are being filed on this topic. But the department will now use this circular to bolster its point of view, and they'll try and argue that you can't have a lower rate without a notification being issued by the Indian side. Again, when it comes to some of the other income streams, FTS is one popular one, fees for technical services, where sometimes you use the make available clause to say that the tax rate should be nil. Whether that can be done without a notification, again, is going to be a very controversial topic. We've seen some of the authorities overseas say that India should not be withholding tax because of MFN, because of relying on make available. And now, the Indian entities are going to be caught in a difficult situation, when they need to decide what they should do. And we've tabulated here, somewhere how it could impact the payee and the payer. I'll talk about the payer first, which is, an Indian entity making a payment. Let's say India has considered it as non-taxable, and the revenue view is that it is taxable. Then you are having a risk of 40A disallowance. You are having interest risks. So these issues, is going to, penalty to our mind is defendable. But the Indian authorities are going to, say that you are not going to get a deduction for this. So there will be a 40A disallowance and related interest and penalty exposures. There will be the 201 demand as well on the payer. So all of those risks are there. And therefore, whether when there are transactions between third parties, should you go and do this? Probably the answer may be that you should be conservative. Let the other entity file a return and claim a refund. That's a better way of, doing it when there are transactions between third parties. However, if transactions are between group entities, again, the question will be, is the other entity getting a foreign tax credit for the India withholding? Then let's be conservative. That's a simpler answer. But if the foreign entity is not getting a FTC, and this foreign tax credit is a cost, either because that income is not taxable in the foreign country, or because they have losses, or their peculiar situation results in the tax withholding in India becoming a cost, then one needs to see whether one should look at taking a beneficial position, even if it is litigative, and how to reduce the risks of litigation one needs to evaluate. But depending on facts, like I said, if it's a third party, better to withhold, be conservative. If it's a group entity, if the group entity is getting full FTC, then you can be conservative. If the group entity, this withholding is a loss, then you need to probably relook at and take a considered view, I would say. And if it's a net of tax contract, it is a cost on the India entity. Again, in those cases, the payer should take a considered view. So, that's the way I would look at it from a payer perspective. Insofar as dividend is concerned, also, if a lower rate has been considered either for dividends or even for other income streams, there is no penalty. There is no penalty risk, or penalty risk is there, but it is defendable in our view. So, that's the way I would look at it from a payer perspective. And from a payee perspective, again, there is a risk, but the payee will need to file a return in India to get the benefit of a lower rate. So, whether the payer has taken the lower rate or not, return filing by the payee is mandatory, because he's taking a beneficial position as per the treaty. So, that really, in essence, is there are risks which are defendable. Penalty risk for lower rate, is non-existence, because there's no underreporting of income. Income is correct. It is the rate of tax that is lower. So per se, there is no penalty risk on a lower rate. But when it is considered as exempt, the risk is there, which to my mind can be defended. So I'll take a pause here. If any questions are there on this. So I'll move ahead, then in that case, to the, how the MFN circular issued by CBDT, how does that contradict the Delhi High Court in case of Concentric's, decision? And, this was part of what the revenues arguments were in front of, the Delhi High Court. And, they have said that, this lower rate should be available only if the country with which India enters into a DTAA was a member of the OECD at the time of execution. So this is what they've said in their argument. And that's precisely what they have put into the circular as well. Similarly, they have put up this argument of a notification being there. That argument they put up, and Concentrix kind of, has adjudicated on both these topics. But now the circular goes and, issues a notification which is bolstering their arguments, which is articulating their arguments into the circular. So, is the circular then adopting the correct legal position? Is this not in conflict with the Concentrix decision? That is a topic which, to my mind, will get decided very soon. I think in one of the Saint Gobain entities, there was again application under 197 filed for a 5% withholding after the circular, which was denied, and a writ has been filed. There was an interim order passed on 3rd June by the Delhi High Court, saying that the company can do a tax withholding of 10% under protest. And they said that depending on the final outcome of the order, whether 5% or 10% is the right rate, we will decide, and this amount will be treated as paid in protest. And they've given the revenue authorities 4 weeks to come with their point of view and their arguments on this topic as to why have they not followed Concentrix. So we will have some, I would say, judicial precedent on the circular and the validity of the circular insofar as dividends are concerned, very soon. This is in the context of India-France treaty that this particular decision, the decision is being litigated. Again, on the topic of whether circulars are binding in nature or not, you have a lot of decisions which say that they are binding on the authorities, but they are not really binding on SSCs or on judicial forums. So appellate authorities, can very well decide, what is right these circulars are not binding on courts, they are not binding on the appellate forum, and they are not binding on the taxpayers as well. So revenue authorities, if you go for a 197 ruling, for them it is binding. They cannot issue a 197 order which is not in sync with the circular. But in litigation, you can very well argue that the circular is not valid. So that I think is a common principle, and I'll not spend too much time on it. So you will have litigation on this, and you will find a lot of precedents coming up on this. I think there's one judicial precedent of Pune already on this circular, and this is in the context of GRI renewable industries. And this was again the Pune tribunal. If you read the body of the order, it goes on to say protocols and MFN should be automatically applied. There is no need to have a separate notification. That's what it in essence says. But then it goes on to look at the circular, and insofar as the circular is concerned, it concludes to say, while the circular is there, it cannot be retrospective. And they said that we are looking at one of the years which are pertaining to a period prior to issue of this circular. So they've said the circular cannot operate retrospectively, and therefore they chose to ignore the circular when taking this decision. Now, whether post the issue of circular, how should one interpret, that is not really covered by the decision, though if you read the body of the decision, it seems to suggest that protocol, you don't need a separate notification. It should apply in an automatic fashion. That I would say is the essence of this Pune tribunal decision. So really, this is where I come to my last slide now, and I'm keeping some time towards the end for Q&A. But some aspects before we conclude, India issuing this circular in February in this 22, which says that the notification is needed, it should be an OECD member. And that itself is a unilateral measure taken by the government. How are other partners going to react to this? So Switzerland, one of the officials has already made a announcement to say that from Jan onwards we will stop granting credits. If India were to, and somewhere the Swiss statement also, which was issued in August last year, that had a last paragraph to say that if a reciprocal treatment is not granted by India, then Switzerland reserves the right to kind of reverse all of these benefits that they are giving, and they will go back to the old position. So in a way, Switzerland has indicated that they will then on their own, if India is not cooperating and India is saying they will not, Switzerland will also follow suit, which India may very well be happy with. India may not have an issue with that, but at least it somewhere creates a conflict between two treaty parties. And how does this get solved? And when these kind of contradictory circulars are issued, should there be a framework, consultation framework to address these kind of situation? Should mutual agreement procedures be followed? That's something that is food for thought. How should two countries will need to sit with each other and sort this out? There's no mechanism per se given in the protocol or in the MFN clause itself, but we would expect that the two countries should sit together and close this. Again, will this open some of the earlier closed cases because of the circular? People who took benefit earlier, will they be reopened? Very well that risk exists, but there is that Pune tribunal decision at least which says it is not retrospective. So to that extent, one can rely on that to counter any of the earlier closed cases. Again, indirect application of MFN clause. There are scenarios. In the context of dividends, we had a scenario where under the protocol to the Hungary Treaty, there is a specific language in the Hungary Treaty to say that DDT paid by an Indian entity shall be deemed to be tax on dividends paid by the shareholder. There's a deeming fiction in the protocol to the India-Hungary Treaty. And some of the countries which can through MFN use India-Hungary Treaty would like to rely on that and say that the DDT is virtually equivalent to tax on dividends paid by the shareholders. And then they would probably like to also rely on another MFN to say the instead of 10%, the rate should be 5%. So, can you apply it in this fashion? Two different treaties through MFN. Can you apply is one controversy. The other controversy is, and there's a Netherlands Supreme Court decision where this was under the South Africa-Netherlands Treaty, which was signed in 2008, which said that any treaties which are signed after that date, you can go and take benefit of. And the South Africa-Sweden Treaty signed in 2012, that said you can go back. And we spoke about it earlier, there was a South African advance ruling on that. And, under the South Africa-Sweden MFN or under that treaty, they could go back and take the South Africa-Kuwait Treaty, which was dated 2004. Now, the Netherlands Supreme Court, they said that in interpreting the Netherlands-South Africa Treaty through the Sweden Treaty, which then goes on to the Kuwait Treaty, you can import the Kuwait Treaty benefit. The South Africa-Kuwait Treaty dated 2004. You can import the 2004 Kuwait Treaty benefit into the 2008 South Africa-Netherlands Treaty through an indirect application. So, there are these nuances which, will get tested in India as well. You have some of these decisions right now, but, we'll see how it goes forward. Again, I think this was a question that we spoke about earlier. I think Sachin had asked this question, what happens to some of these conditions, limitation of benefits, GAR, PPT, the 365-day condition in some treaties that has got introduced. Would all of these also get imported when you're importing, some beneficial provision from the MFN, and debatable topic. My personal view is yes, it will come, those conditions will get attached. But, there is a point of view to say that, you don't need to look at this as well. And I think the last point here on the slide, which is on the pillar 2 discussions, which have this minimum tax rate, global minimum tax rate, which should be there. The subject to tax rules do say that in certain circumstances, the source countries, if the recipient country is not having a minimum tax rate, then the source countries can do a withholding at a minimum rate of 9%. That ability is there. Of course, it comes with a lot of conditions and it's still under discussion. But if that happens, then you could very well have a situation where, India may say that we'll not, we will apply this STTR rule under pillar 2 and, therefore have a minimum 9% rate and will not give the MFN benefit of a lower rate. Again, STTR is applicable on base eroding payments. So it applies normally on royalties and FTS. Whether it applies to dividends or not, I think the way the current version of STTR is worded, it should not apply to dividends. But I guess some countries are still pushing for a point of view to say even streams like dividend should get covered under STTR. And that is where, India, depending on how the pillar 2 format and provisions are finally finalized, we may have, how it interplays with MFN as another topic to be evaluated. If there is a minimum 9% rate, you cannot have a 5% or a nil rate coming through MFN clause. So, that is a interesting point to be watched out. And, with that, really, this is what I had to cover today. I'll just end with, a quote over here. There was a quote by Chief Justice John Marshall. He had said, the power to tax involves the power to destroy. He said, power to tax involves the power to destroy. And about a century after that, Justice Holmes said, the power to tax is not the power to destroy while this court sits. So somewhere he's saying judiciary will have the power to interpret and, ensure that, the power to tax is not used to destroy. So, I would think on MFN, we'll have judicial precedents coming up and interpreting a lot of these controversies. It's an area to watch out for. But yeah, I will thank you for all your patient listening, and I'm happy to take questions.
So based on your experience, especially, with this MFN clause controversy, whether people are going for 15 CB certificates from the chartered accountants or they are more going under 197 route.
So see, 197 route, to my mind, you need to be ready for a negative answer
Exactly.
and then
That's what.
file a writ.
Yeah.
And at least, that I'm not seeing too many people in Pune do that. I think it's a popular option in Delhi, and insofar as Pune is concerned, the route is still 15 CB. So, it's more a case of companies taking a call. Either they are saying that we'll be conservative and withhold at the higher rate and let the recipient file a return and claim a refund. I think that's one alternative that some companies are doing. And some other companies are saying, no, we will be aggressive. We will take the lower rate and we will take a 15 CB. Not too many are still exploring the 197 because they are expecting, and with the circular I would think you will definitely not get a favorable answer under a 197 application.
Okay.